Congratulations on becoming a parent. It's an incredible feeling, isn't it? It's a new phase of your life. Generally, family gets serious about their financial health only once they have a child. There will be million dreams in your eyes and a lot of things that you're thinking of. One of the things that you'll be thinking of is how to secure the future of your child. Well, it is the topic of our today's video. Welcome to Baniya Ka Munafa. It's me Pulkit again. In this video, we will talk about how to plan and secure your child's future. So let's get started. So the first step is not about investment, it is about protection. What do you need to do is increase your life insurance coverage. And in case you don't have any life insurance, I strongly recommend to get a life insurance plan now. And as a thumb rule, I think increase your life cover by rupees 50 lakh is the minimum you can do. Life insurance is really important. Means if you die, your family will be affected and your child will also be affected. So the first thing you must be ensure that you should have a life insurance policy, or you can get a term plan also. As a thumb rule, term plan is almost 5 to 6 times of your annual income. Or you can also take help of your financial planner or financial advisor to help choosing life insurance or term insurance. Or you can also buy online term insurance plan or term plans, but that have its own advantages and disadvantages. And the second step is get the baby added into health cover. If you already have a health insurance plan, either both yourself or through employer, make sure you add the child to the policy the moment they are born. If you don't have health insurance, then your investment plan is derailed because a small hospitalizations can actually upset your investment plans or saving plans. So if you don't have the health insurance yet, I would recommend to get a health insurance and make sure the kid is a part of the policy. But some policies already cover your newborn child without any extra premium from the birth itself, but provided that they have also paid for the maternity claim in the same policy. So after getting these two plans, you can think of investment. You can't look on investment before you complete your insurance requirements. Step 3. Start a saving bank account for a child. One of the best things you can do for your child from the start itself is open a saving bank account for the newborn the moment they are born. Almost all the banks have facility for kids to open their bank account. I would recommend to put all the cash gifts in the kids bank account. The moment your child is born, for the next many months and years, you will start getting lots of gifts in form of cash. And we often seen that this money is not handled properly in families, maybe because of its small size, and it gets consumed and finally evaporates. You can always make a rule that all the small or big money coming in the baby name on their birthdays or any baby functions will be deposited in the saving bank account opened for the kid. And the next investment option is Sukanya Samriddhi scheme. Sukanya Samriddhi scheme is another good scheme to invest, but this scheme is only for the girl child. So if you have a girl child and you are planning to save for her marriage or education, you can go for this scheme. This scheme is applicable only for those who have girls below the age of 10. So this scheme is really very simple. It will give you little more return than PPF. Interest rate is around 9.1%. It will also give you tax benefit. It will give you ATC benefits. It's a fixed income product. It will give you defined return. So if you're going to invest for a girl child, I would say that this is the best saving scheme with zero risk. If you open account today with 3,000 per month, then you will nearly get 20 lakhs after 21 years, taking interest of 9.2% constant. But if you're willing to take a little risk, you can invest in mutual funds, which will give you higher returns. With high risk comes high return. 13 lakhs rupee, if that is the cost of an education course today, in 18 years doing an 8%, its future value would be 50 lakhs. You cannot reach this just by playing safe. You will need to take slightly more risk, but adequate investment. So we recommend equity funds. You can go through the systematic investment plans, SIPs. Take a look at 3 to 5 years performance, or by consulting financial advisor you can pick a fund. It's really important because equity investment of nearly 10 years would give you much more returns than any other investment. You can take the help of a financial advisor and do SIP for your child future in one or two diversified mutual funds. And you also have a time in your favor, and power of compounding will do wonders for you. You will require bulk of your money when your baby is 18-year-old, and if you invest through SIP at almost rupees 10,000 per month, you can accumulate around 98 lakh rupees at 15% returns. That is almost average return, whereas your investment amount will be rupees 21 lakh 60,000. As I always say, power of compounding is the eighth wonder of world. Next option is gold saving, or investment through gold ETF. You can invest in gold for a child of yours, but don't do it through physical gold. The best option would be the gold ETFs. There will be no locker or no storage charges. And also, you can invest in the electronic form, and there is no worry of theft. And gold ETFs can be sold and bought like mutual funds through the Demat account. Also, you can invest small amount each month. And as we all know that gold has generated much better returns than most asset classes in the more longer term. So typically a holding period of around 10 to 15 years could result in a decent gains. But there's a disadvantage that you have to pay capital gain tax or when you sell it. PPF is the most popular tax saving scheme and the long term investment scheme which can be opened in post office or banks. The interest rate on the PPF is market linked now, and one can invest up to 1.5 lakhs in a year, and you will also get ATC benefits from it. And it matures in 15 years, but the tenure can extended in block of 5 years after maturity. And if we talk about FD, you will receive regular income by the interest payment that are made every month or quarter. It's very safe investment, but this investment can't beat inflation. And the next important thing you will have to do is you also need to make some adjustment in term of nominations of various investment and various assets that you hold. It can be your bank accounts, fixed deposits, mutual funds, or even some property. You might want to add your newborn as one of your nominee in the assets you own. Well, these were the few things you need to do after the birth of your child. So, as a conclusion, if you want to play risk free and you're satisfied with comparatively low return than mutual funds or equities, then Sukanya Samriddhi scheme and PPF would be the best options, I guess. Because they offer the best interest rate, and the interest rates are tax free in the hands of the investor. But investment plans and options are based on your own ability to save and the tenure. It might be possible that there might be other aspect to it, so please write to us in the comment section below. And if you like this video, please give us a big fat thumbs up and make sure you have subscribed to my channel. Thanks for watching.